Money Matters with Matt and Rich, episode 17. Good morning, Matt. How are you?
I'm great, Rich. How are you?
Great. We've got a great episode today. Special guest from Top Wealth Agenda. You can go on topwealthagenda.com. It's a bank on yourself, bank on you principles with Mark Bashirs. Got him live from, are you in Naples or what part?
Yes, I am.
Yes,
Yeah,
Naples.
Naples, Florida.
Yeah, we were just talking about the market in southeast part of the country. You know, Florida in particular, just a booming market like all the time. Like, pretty consistent market from a home appreciation standpoint. I think just want to touch on the Fed rates today coming out 2 o'clock, 2:30.
Yeah, fun for everyone.
Yeah, Mr. Powell should be hitting us at 75 basis points, but we'll see. But that's the ongoing word.
Right.
How does that,
Yeah, so I mean, we haven't seen anything today in terms of movement.
Yeah,
I
the
think
mortgage rates?
Yeah, I think lenders have just baked it in anyway, so I don't think we're going to see any movement on the mortgage side. Auto, credit card, that stuff we'll see another hit, but mortgages I don't think we're going to get hit this time when they raise them again in December, which is likely going to happen. Sure. I think that's when we'll see another adjustment, but right now we'll probably stay steady.
Sure, good to know. Thank you.
Yeah.
Well, Mark, tell us about yourself. Tell us how you got started, and give us a little insight on, maybe you can even tell us if like Fed rates and things like that affect kind of what you're doing. But
Sure.
Give us a little insight of what you got going on.
Sure. Well, I'll maybe take you back to the beginning. I started out of college in the golf industry, actually. I became a PGA club pro and worked my way up the ladder to general manager. And then next thing you know, I was running major resorts and ended up running 11 major resorts in the Southeast region. And that's what actually brought me to Florida. So I was in the golf industry, resort hospitality industry, and then Goldman Sachs bought our big company, and then Goldman Sachs broke us down. We had 300 properties, and next thing you know, they sold 200 of them, got all their capital back in their pocket, and kept the best 100 properties. So I found myself selling myself out of a job. I was like, whoa, wait a minute. What about me?
Right. Right.
Yeah. And then but it actually worked out for me. I really wanted to get into real estate and development because I was around it every day, all these golf communities,
Oh, yeah.
So I saw all the real estate guys were playing golf on Saturday and Sunday, and I was working.
You're like, I want that.
Yeah.
What am I doing now?
What am I doing wrong? So I actually got threw my hat in the ring to do some real estate development in Punta Gorda, Florida. And right around 2002, the real estate market in Florida was on fire. Everyone wanted a piece of Florida, and that's speaking globally. So I actually found this waterfront property to be built. Got my hands on the project to build 140 condominium units on the Peace River.
Nice.
And I pre-sold all 140 to a whole bunch of Europeans. Pre-sold with 35% deposits.
Oh, crap.
Contracted, all I got to do now is build
it.
Right.
Yeah, but actually, first thing I got to do is get the money.
Right.
and I wandered in with all those contracts and put them on the desk of a big bank, and I'll be darned, they loaned me $40 million. And I was
easy as that, huh?
that tells you a little bit about the time, right?
Yes, gonna say.
About the lending environment.
Yeah.
They had no business loaning me $40 million.
No, they didn't care who you were. They just saw these things and were like, yeah, that's about right.
That gets through compliance
that's good.
And underwriting and all that kind of stuff. So I'll be darned. It's going to happen. I'm going to build this project. And sure enough, we get underway. We're 4 stories high, under roof, and a weather event happens. Hurricane Charlie blows into town, direct hit to Punta Gorda. If you guys probably don't remember that, but it was 2004, and knocks my buildings down. And a few months later, Hurricane Ivan comes across the East Coast. No one remembers Ivan, but I do. And it blows across my property again, and we're losing time. And so that's 2004. Got to kind of half start over, find the material, labor, all that kind of stuff. And by 2006, we're getting close to finished. And I'm like, I don't know, the market's getting getting a little fickle here. The buyers are concerned about hurricane problems. I don't know if I'm going to make it to the finish line, right? And so I walked into my attorney's office and I said, you got to protect me. I owe $40 million. I don't know how this is going to shake out, over the next 6 months, if my buyers close or not. And so he went down a asset protection checklist, and in that questions, he said, do you have any whole life insurance? And I was like, what does that have to do with anything here? That made no sense to me. He goes, and I actually got a little frustrated. I said, is the bank going to take me out? What's this? I don't get it. And, I was only 36 years old at that time, with 2 little kids at home, and and obviously I haven't had any income yet because I was all banking on the end, making some profit. And he said, no, don't be silly. Cash value life insurance is creditor proof. So if you have some of that, the bank would not be able to pierce that. And I was like, that's an interesting concept. And how come you didn't tell me about that?
Yeah.
3-4 years ago.
Yeah. When we first chatted, right.
Yeah. And so that little moment put me on a little crusade to learn more about what is this life insurance? What's it all about? And I heard a radio ad called Bank on Yourself on satellite radio, and I call on it, and I'll be darned, what are they talking about? Whole life insurance.
Mm-hmm.
So twice in the same month, basically, I hear about whole life insurance, but never once did I hear about it prior to that. But I heard about every other Wall Street product possible and every investment opportunity, the IRAs, 401ks, the Roths, and all that kind of stuff, which society's conditioned to go down that path.
Yeah, we've all been taught that's what you do, right? 401k,
that's what you do.
Roth, traditional, and that's it.
That's right. And there's even a lot of big articles out there about the 401k. The original founder that crafted and drafted the 401k documents now says he wish he never would have done it because it's not working the way it was intended to work. Anyway, that's a whole nother topic. So
we can hit that one another time.
Yeah, it's just, again, society's conditioned to go that route. I went that route out of college, put a bunch of money in from 1992 to 2002 into 401k, only to get crushed 4 times in that decade.
Right.
whether it was 9/11, the .com crash. So again, I'm getting frustrated about everything, losing money in every venue, and now I'm potentially not going to make any money in my real estate project. So,
how do you protect yourself?
Yeah. So I'll finish that story. The project did get to the finish line. However, the last 15% of the building didn't close, which is really all the developer profit.
Mm-hmm.
So I did get the bank paid off. Thank goodness. That was keeping me up at night. Got the bank paid off, but we had the last remaining inventory, and the real estate then bottoms out. You couldn't give away a condo.
Yeah.
I mean, literally, you could ask somebody, "Would you want the keys to that condo?" And they just say, "Nope, don't want any."
Too scared of it. Yeah.
Too scared of it, and they don't want the association fees and all that kind of stuff.
Yep, they'll be losing money.
So the end of that project, was the end of my real estate development opportunities, and the real estate industry was in the tank. So I had nothing to do, right? So I really put my head down and studied the heck out of this life insurance concept. And 2010, then opened up my shop and started teaching people. And we've never had a bad day. I have hundreds of clients around the country, and we never lose in volatile times. And volatility is the kiss of death in investing and or in real estate, right?
Yeah. And that's, I think, probably you'll expand on that more, but I think that's the important part of kind of this conversation is, stocks, 401ks, even real estate, they can take some dips. They come back. In history, they've always come back, but you're getting those hits. But I think what you're talking about is to kind of mitigate that risk of those hits in something a little more stable.
Yeah,
but while also producing some sort of benefit.
Right. So, like I'm commenting, society's guided and pushed toward Wall Street products in many shapes and sizes, which is investing. That's a concept of investing. And when you invest, you also introduce risk. When you invest, a lot of people think just because you're putting money in your 401k that you're actually making money, because in one quick downturn, you're not making money. You actually have less than you put in.
Yeah.
So if you can visualize a pyramid, you would want your most solid assets at the foundation of your pyramid, right?
Sure.
The broadest, its deepest. That's what doesn't tip over when times get rough. But what most people are doing is they're putting money into Wall Street products, which is at risk, which is at the pinnacle of your pyramid, which you want the least amount of your assets in the high risk category. So at the bottom is low risk and guarantees in the foundation. And at the top of your pyramid is where you're speculating, hoping to make a rate of return. But again, everyone's got their pyramid upside down, going first place into risk before building their solid foundation. And that's where it's changed my life on how I've set up my household, is that I'm building as big a base and wide a base as I can, which then gives me permission to take some chances into investing, which again is going to be a lower ratio of my overall assets.
Yeah, so it's still important to have that diversification, because there's different positives to that. But yeah, building your base with a less risky, solid foundation is important.
That's right.
If you're going to be then building up and doing some different, more risky ventures. Yeah,
that's right. And here's what the whole brand name of Bank on Yourself is talking about, is that as you're building these cash value, dividend paying life insurance policies, as the cash value is growing, and by your contributions and by the guarantees it provides you and by the dividends that tack on top of everything you've put in, you have access to that cash, no questions asked, in the form of policy loans. And when I say no questions asked, literally, it's just sign, send your form in, the money will be electronically sent to your bank. It's your money to exercise with. And when you borrow against the policy, here's the Bank on Yourself concept is it doesn't interrupt its guaranteed growth for its future. So you got to let that set in. Do you have a financial tool in your toolbox right now that will continue to grow as if you didn't borrow it? When you've borrowed against your policy to maybe buy, let's say a spec home, or let's say a flip, right? You borrow against your policy. You bought a house to flip, and it took you 6 months to fix it up and then put it back on the market, maybe 6 more months to sell it. And hopefully you sold it for a profit, right? Mm-hmm. And so you sold it for a profit, and your policy continued to grow as if you didn't borrow that money. So you had your money working in 2 places, one in your policy and one on your property that you're going to flip. Then what do you do with that money? You plow it back into your policy, making your foundation even wider and taller.
Right. I think that's really powerful. What you just said is that, you can borrow against it, but it will still grow as if you did not borrow against it. I think that's a really important thing to kind of harp on a little bit there.
Yeah. Yeah. So I actually got a quick question too. I know the answer, but for the people that are listening that don't, they hear cash value, and there are some people that don't have a life insurance policy, whether it's whole or term, that are like, what does that mean? So can you explain what the cash value actually is? Like, what do you mean by that?
Sure. Cash value is your liquidity that's residing inside this contract, inside this policy. And then some of the other benefits on top of that policy is there is a death benefit. Mm-hmm. You'll hear me talk 90% about the cash value, leveraging the cash value, mm-hmm. the growth, the guarantees. But there is also that protection on the outside. Mm-hmm. Heaven forbid something happen. And here's the other cool thing is, as your policy is growing, your death benefit is also growing into the future as well. Mm-hmm. So it's not a fixed contract like if you bought a term policy today. It's level, and then 99% of the time you're going to outlive it. And right. that you've rented that insurance for that window of time.
Right.
But with whole life, it continues to prosper.
So just to give numbers out there. So let's say you have a cash value of 20 grand, let's just say. So you're saying with this policy, right? You could take out 10 to invest, put wherever to flip, down payment, whatever it is, but your money's still growing at whatever percentage as if it 20 grand is still in there.
That's exactly what I'm saying.
Okay, perfect. Just want to make sure that that's like very clear out there, just because there's a lot thrown there.
Right.
So yeah, I mean, that's awesome.
And you can borrow approximately 90% of whatever your cash value is. So it's not just 10 grand on 20. It's 19,000 on 20.
Mm-hmm. Right. And like you said, there's no questions asked, right? And I think that's the biggest thing with the 401k that a lot of people are realizing is you got to wait until you're 65 right now. Lord knows how late it's going to be in 30, 40 years, right? It might be 75 to take the money out unless you have this extreme circumstance that they label you. There's like 3 options essentially that you could take the money out without getting absolutely hammered with penalties. And I know that's been a big turnoff for even me where, I'm putting money in there, but I was putting a hell of a lot more last year versus once you actually learn about where else money can go. So I think that, that's a huge benefit just from somebody on the outside that doesn't have a whole life policy, just to think about the other avenues.
Sure. Now, here's the other fun part. When you borrow against the policy, you're in charge of how and when to pay it back. Not like a bank, right? When you go to the bank, you sign your life away and a whole bunch of papers. You're on the hook every 30 days. I mean, and what happens if you don't make a payment? Well, now they're knocking on your door and you're getting the hate mail and all that kind of stuff. But when you borrow against your policy, you're wearing both hats. You own the asset personally. And now you're acting as the lender and the borrower in that equation. And so let's just use the car example. It's time to buy a car, and you go into your policy and you borrow out of the policy. You march down to the dealership and you strike the best deal for cash, right? Well, now in that equation, if you had the option to use the dealer financing, right, and you would have been on the hook for 48 months to the dealer for, let's just say, $500 a month, you could have taken that option. And at the end of those 48 months, you got the car, the dealer's got the cash, and whatever interest you paid the dealer, right? Mm-hmm. Well, now let's run that same equation through your policy. You borrowed from your policy. You went and bought the car for cash. But now you want to be an honest borrower to yourself, right? Because you need to repay yourself. And so every month, whether you allocate $300, $400, or $500, it's up to you how to pay it back and at what sequence. But let's just say you did send $500 a month to yourself to pay yourself back for 48 months. You've got the car. Your policy has all of those payments back in the policy ready to deploy again another day. And you had 4 years of compounding growth as if you never borrowed it. Does that sound like a good way to buy a car or what?
Blowing my mind.
Sounds way better to me, to be 100% honest with you. Yeah. I think the big thing is the fact that it still grows even though the money's out. Like that is almost mind-blowing.
Yeah, that's powerful, right?
Right.
And it's society has a bigger need for capital than it does for chasing rate of return.
100% agree on that.
Mm-hmm.
Yeah. And so to build this instrument for yourself, for your family, is going to have many applications. Car is an easy one. Kids' college funding is another easy one. Society's drug into Wall Street products, buy a 529 plan, which then is now invested in the market again, which is speculating. Mm-hmm. Why wouldn't you want to have the guarantee, 18 years from now when your kids are ready to go to college, that you're going to have these funds available to deploy? And another cool fun fact is that when you fill out your FAFSA forms for college, mm-hmm. And they ask the parents about all their assets and all that kind of stuff to find out if you're eligible for certain, grants and things, your cash value contract is a private contract between you and the insurance company. And that does not need to be disclosed on those FAFSA forms. So for all your parents out there that know what I'm talking about, is this is going to help your kids.
It's shelter.
Exactly. Shelter whatever assets or financial liquidity that you might have. You can shelter it there. Wow.
Is there any I don't even know if you can like guarantee anything, right? But is there a set number that either a general life insurance policy will get in a rate of return, or does that differ from, person to person, company to company? Do you understand?
There's a lot of factors.
Yeah,
One,
I figured. So.
Age, health rating, the size of the policy.
Right.
But there is, and I can document it for you on the illustration. It shows you exactly the guaranteed amount of value that the policy is going to have. Guaranteed, what I mean by that is as if it never awarded you a dividend. Mm-hmm. It's just guaranteeing X plus X gets you so much money each and every year for the rest of your life. Here's what it's going to be worth. Now, the companies that we use are 100 plus years old, A plus rated, and have always paid a dividend since the day they opened. During the Great Depression, COVID, they've always paid their dividend. So you got your guarantees plus your dividend gives you your total net cash value. And here's another way to, I didn't even touch on it. Can't believe I didn't bring it up already. So as the policy's maturing and growing from its guarantees and your contributions and all that kind of stuff, it's doing that tax deferred. So no 1099 year over year, anything like that. And because the way we engineer it, they're not modified endowment contracts. There's a legal term or an IRS term. So that means when you take the money out of the policy down the road for retirement income, it's coming out tax-free.
Oh, interesting.
So by building this instrument, your tax footprint in the future. It's zero.
Wow.
So in your IRAs and 401ks, do you know what your tax footprint is when you need it down the road? You just know you owe taxes.
Yeah, we won't know what that rate is or what that looks like. Yeah,
especially if you're traditional, especially you literally have no idea.
Yeah, I mean, tax over the last 100 years, actually, tax rates are low currently to history. When you look back in time, we had tax rates get as high as 90%. Jeez. Can you imagine living in those times?
No.
Yeah.
No, thank you.
Right. So anyway, just having this instrument has so many applications, but then on the backside, taking out tax-free dollars really challenges the idea of chasing rate of return again. Because let's just say you take $10,000 out of the policy and it's tax-free. Well, how much do you have to take out of your IRA account net of taxes to net you 10?
Right. Mm-hmm. Right.
Well, no.
So, yeah, you won't know but you got to take out more to net 10.
Right.
Which means we'll deplete it faster.
Right. Right. So here's kind of the first devil's advocate question, I guess you could call it, just to, again, play both sides here. What do you say to somebody that says, I don't believe in whole life. I only believe in term because, I don't know, think of an example. I can self-insure myself when I have $1 million in 30 years. Like, what's kind of the combat to that? What do you usually tell people?
There's no guarantees in that concept. What you're saying there is the Dave Ramsey, Susie Orman, buy term and invest the rest in some financial product. And I'm not saying there's no place for Wall Street products or investing in real estate or anything out there. I'm saying you got to at least educate yourself about this instrument as part of your foundation. Mm-hmm. Then you have permission to go and play in the other environments. But all too often, everyone does it the other way around first, and that's when people get hurt. And I've seen people get hurt from Wall Street crashes, and I've seen people get hurt from real estate crashes. And all I'm trying to advocate for is that when you have this instrument in your toolbox, you actually get to be the best shopper. And what I mean by that is you can wait for things to go on sale.
Right. That's literally where my mind went to.
Yeah. Because you don't have to go chase every day for the best deal of the week. You don't have to do it. Let's just give it time. Let's let an event happen. And there's going to be another event. We just had COVID, right? That was a major event. And so many of my clients made so much money in the COVID event. who are very conservative. I mean, they're tight. They don't take risk. Mm-hmm. But COVID and Wall Street went on sale 40%, right?
Mm-hmm.
Right after, it went down
March 20th.
Yeah,
2020.
Yep.
I remember buying a lot of single stocks I'd never bought before, but they, like you said, they're on sale.
I mean, it was hard not to, right?
Yeah. Came out a year later. I mean, I didn't put a lot in, but it came out a year later, 20 grand on top. I was like, wow, that was great.
This is amazing.
In 1 year.
Yeah, it was great. So imagine how we did in my circle of clients.
Yeah.
They borrowed against their policies. They bought some really grade A stocks on sale, and they were mapping out the idea it'd probably take 5 years to return. That was the mindset, the conservative mindset. So we kind of have this policy loan hanging out there for 5 years with the idea, all we're really looking for is the stock to return to its original price, not new to all-time highs.
Right.
Just get back to normal. And what happened? It happened in a year.
And 12 months, and it went way up and above where it ever went before.
Right.
Mm-hmm.
Yeah. So that's what we talk about is, when's the next event and we get to go shopping.
Right. Right. So the policy loan is that able to be called at any point in time, or is it literally you pay it back on your time? Like, that's as simple as it gets.
That's a great question. So let's just imagine you did go out and you bought that car, right? And you never made a payment back to your policy.
Mm-hmm.
And you live another 40 years. And yet when you die, that death benefit's going to pay out minus whatever that policy loan value is.
Right. Right.
So you have the ultimate collateral.
Right.
Because the death benefit's always going to be north of your cash value and always north of what your policy loan was.
And always growing.
And it's always on this hockey stick curve.
Mm-hmm.
Exactly. So, and the insurance companies understand that and know that. So that's why it works for them too.
Right. Because if you don't pay it at all, they're still making out too, because they're just taking it off of your benefit. Is that right?
That's it. Yeah, right. That's it. That's right. And it works on both sides.
Right.
And from the loan standpoint, what's and maybe this is up to the particular person, but what's like an interest rate, or is there one?
Yes, yep. That is. It is a simple interest rate, and it's at 5%. And for the last 12 years that I've been doing this, the highest I've ever seen it get was 5.75. But it does have the ability to move. It moves with the Moody's bond index. But it can only move a quarter point at a time.
So that's also to know too that it's tied to an index. It's not just like someone wakes up pissed off one day and says, "You know what? You're going here.
You're going to 8."
Right.
And when you say simple,
oh yeah, go ahead.
And when you say simple, what does that mean?
Well, like in your mortgage business, right? Mm-hmm. You're on an amortized schedule where when you make a mortgage payment, you're paying the interest first and then reducing the principal after that. So with a simple interest loan, every payment you make back to that policy loan is driving down the principal balance 100%. So if you have a $10,000 policy loan out there and you send in $1,000, then that $1,000 reduces the loan balance to $9,000, and which means now we're calculating interest on a lower balance. And what happens is on your policy anniversary, they'll send you an update. Hey, over that 12-month window, here is the amount of interest that accrued during that 12 months. What would you like to do with it? You actually get a little notice. And you can write a check and pay that interest, and the loan balance stays the same. You could let your dividend pay that loan interest if you want. I don't advise that, but it's an option. And then here's the most interesting part. What if you could just say, I'm not paying the interest? And again, no hate mail, no credit problems, nothing like that. They'll just apply the interest to the loan balance, and it carries into the next policy year, which is very common for my real estate clients that do buy flips, real estate. They go into their policy. They know it's going to take time. They go buy the house, then fix it up, then time to sell. They never worry about that accruing interest. because they just know it's going to be part of the total loan repayment when they sell the house.
And it's likely cheaper than any hard money out there.
Yeah,
I mean, not likely, definitely.
It is.
That's the fun or joy that I get, is teaching that to that group of people, because they get off of the hard money line.
Mm-hmm.
They can wean themselves off of that lender.
Yeah, no more 10, 12% interest. Yeah,
right.
Might even be higher right now, honestly.
Right, right, exactly.
But to take it back a little, probably like 10 minutes ago, I liked what you said. Probably paraphrasing, but you were saying, people get so focused on the rate of return and not, the actual what the investment is or the money that they're throwing in that they could potentially lose. I relate that a little bit to our business, where especially now everyone's so caught up on the fact that they have a 2.5% mortgage, but they have $30,000 of credit card debt. So like, how smart are you? Like at the end of the day, right? Like how you really don't care about the rate of return, or you wouldn't have racked up, all the credit cards, which unfortunately we see a lot, and people will refuse to cash out and just start over, right? And it just like go from a 2.5 to a 5 and start over because they don't want to lose the 2.5. But it's like, you can't live like the way that you're living right now. So what does the 2.5 mean? So I think that's a really good point, where it's okay, cool. This year you got 8%, but next year you could lose 5, right? Like you could go through this whole up and down cycle with it.
Yeah. The interest that people are paying on their debt is such a headwind that they don't even know it's hitting them. Mm-hmm. And we do this a lot too, with helping people refi, getting some cash out, put it into policy, mm-hmm. into our policies, borrow against the policy to buy all that debt off.
Right.
And paying all those credit cards off, or as the student loans or whatever it is that's creating such a headwind. So we took the money out of your bricks and sticks, put it into a life insurance policy where we do know where it's going to go to, in the future. It's right there on paper. It's going to grow. But then we're going to leverage it to pay off the expensive lenders. But then we teach them they got to be paying themselves back mm-hmm. into their policy to get back on solid ground. So what you're saying is absolutely right. I'm just adding one extra step in between.
Right. And that's just, again, an avenue that I never thought to go down. I mean, I'm not necessarily old. Not saying you're old. I'm just saying, like, I don't have the experience of
not
investing.
Not as old as you were, Rich. Mark.
I don't have like the life experience of investing, so I'm not necessarily one to, it's not like it's like me saying that's like world breaking or anything like that. But it's just, this is an avenue I never have imagined was out there and to go down, right? Like for me, admittedly, I have term life insurance just because and I'm not unnecessarily under the Dave Ramsey mindset with life insurance, but it was more so, okay, like why not, if I can just keep investing into the 401k, this was last year, right, at this rate, like I'll be fine in 20 years and 30 years, everything will be great, right? But it's such a hypothetical versus like you're talking about the guaranteed, whatever that percentage is.
Right. We have going into the 401k, and when you go into your retirement years, the sequence of your returns is going to be everything. Mm-hmm. The sequence of when you made money in your 401 and when you lost money in that 401. So when you retire, okay, and it's happening to so many people right now that just retired 6 months or a year ago, because what's the first thing they're seeing happen to their 401k that is their retirement nest egg?
Right.
Well, when it's getting crushed. And then here's the problem. You got longevity. So you're 65, you're going to live to 85. And if your 401k gets the sequence of the returns for the next 20 years, if the first 5 years are bad, you're going to run out of money. Mm-hmm. If your first 10 years are good, you're going to make it. Mm. But the problem is we don't know what those sequence of returns are going to be until they happen.
Right.
And,
right.
Right. A big event could happen again, something that really depletes it a lot and puts people in a hard position.
Yeah.
Yeah. So having a toolbox filled with these tools, and the insurance policy being a part of it is, I think, important.
Yep. And here's how we mathematically prove that out. So in those years, if you had your 401k was going to be your primary source of income in retirement, in those years that you got negative returns, we would dip into your life insurance policy to cover your needs, the cash to cover your lifestyle needs.
Mm-hmm.
Don't dip it, because if you dip into your policy, into your 401k in those negative years, and you don't give it a chance to rebound, then you're gonna run out of money. So when you have the whole life insurance to bridge the gap of those negative years, because let's just say your retirement years is 20 years. Well, how many market corrections are we going to have in 20 years?
Yeah, probably 2 or 3.
Probably 2. Yeah,
two at a minimum.
Right.
Possibly 5.
Right.
So again, having other assets in cash, again, tax-free cash, to subsidize those years you don't want to dip into your 401k, because you need that 401k to rebound to get you through your full lifespan.
So if I'm someone who doesn't, I don't have a lot of money to like do this stuff, in investing in whole life or, really any sort of 401k, like, I put $20 a week, something like that. Like what is the average, or what's the benefit of even doing, $20 a week to do something like this? Or maybe there is no value to it. Maybe I need to be in a different position.
You'd be surprised. I have clients of all shapes and sizes, but everyone needs capital. Everyone needs cash reserves. So there is no downside to building that for yourself. You can't come up with any downside. I will say it is a patience game. You need to know it's slow in the beginning, but again, kind of a hockey stick curve. And once you make it past that curve, you really enjoy those compounding effects.
Well, and I think, there's no get-rich-quick scheme. Like, everyone looks for that get-rich-quick scheme, and a lot of people can't do the get-rich-quick in 30 years.
Right.
Like, get rich, and like, that's how you get rich in any of this stuff that we're talking about, whether it's buying multifamily properties, investing in stocks, or investing in, yourself with the whole life insurance. Like, they're all the same. Get rich slow.
Right. But, so true.
Yeah. Unless you start out, a $5 million business in a year, right? That's like the only possible way. But
how many people are doing that?
But how many people are doing that? Right. It's like literally the only example.
Yeah. If I could figure that out, I would be doing it.
Right.
What's that business?
And, here's how much I believe in it. Money has to reside somewhere, right? So as soon as you come into that money, you can go in your mattress, you can go into your local checking or savings account, right? Mm-hmm. Or you can invest it. Well, my theory is it goes into whole life insurance first, because I know it's predictable outcome. I know where it's going to be. There's no way it's not going to be here. And in the meantime, if I need it, it's liquid if I need it. So you can't enrich another man's bank to help yourself. So if you can enrich your bank in your policy, you're going to get ahead. And then eventually you're going to amass enough capital in there to take advantage to make some high rates of return when things are right.
Right.
So in my household, this is exactly how we do it. I know what my monthly carry costs are in my household, what our lifestyle is and things like that. So I multiply that by 3, and that's how much money I allow to reside in a bank. And that's just money in a bank for convenience, right? Mm-hmm. To run your debit cards through and pay your bills. There's no reason for me to leave any more money in that bank. So anything north of that dollar value, I shove into my policy. It's my favorite check to write is to my policy, which is to myself, because once I get it in there, it's on the escalator, and I can't change that. That's how we run our household. Right. And then we just look for good deals after that.
Yeah, and I think not only the financial aspect of it and having, this money available, but like you have life insurance now.
Mm-hmm.
Like you've got life insurance that if something does happen tomorrow, next week, next year, your family, you're protected. Your house maybe gets paid off depending on what that, value is of that life insurance policy. That way your wife doesn't have to pay for it. Because that's what I go through with my wife. I'm like, all right, I've got term. I said, I'm going to get the amount of term that pays off this house if I should go tomorrow. And then we've got other, assets out there. But at least that life insurance covers that. But, let's not forget that piece of it too. Mm-hmm. I think that's important.
And just so your audience knows that when that life insurance pays out, that is a tax-free event as well.
Yeah, great. Fantastic, right? Like, no, your spouse or your significant other or whoever gets that policy, they don't have to worry about paying tax on it. Yeah, that's fantastic.
Yeah, that is good.
Yep. It's funny. You just made me think of a couple I sold. I think it was my 7th policy that I put in place. So I was a rookie, still new at the game.
Yeah.
And this couple made more wisecracks, about, okay, now we got this policy. I got to sleep with one eye open. All those death benefit wisecracks. I mean, they just thought it was the funniest thing.
Sure.
And I'll be darned if he dies 60 days later.
Yeah.
Oh,
it can happen, right?
And I delivered a $700,000 check 30 days later to her, which really put me in a new place with this concept of teaching this to people. I was really going down the road all about bank on yourself and how to build money and build wealth and all that. But then it reminds you really quick when something happens and what that meant to her.
Right. Well, because, it's in one aspect, I mean, don't get me wrong, I'm very selfish. I want things, I want assets, I want all this stuff because it's going to grow me, right? Look at me. But it also helps grow my family's, net worth, net wealth. But protecting all of it. Now what do I do?
Right. What's the defense side of finance that nobody talks about? How to be defensive with your assets.
Yeah. Right. You can put some in an LLC, you can have them in a trust, but that's all well and good. But what about getting some of these paid off, something paid off, something, to just establish some level of comfort for you. I've got 2 kids and a wife. Yep. I never thought about life insurance until I married my wife. And 2 years later, she's like, we need life insurance. I'm like, why? What is this? I have no idea. I have no interest in this. And then I'm like, oh yeah, that's right. The house, if you have to live here by yourself. Yeah. All right. I kind of get it now.
So I actually had another question too that I just thought of. Let's say, 20 years goes by and, whatever the cash value is in there. Is there, are you, how do I word it? I don't want to say you're stuck, because I feel like that sounds like too far on one side. Can you pull that out and say, no, I don't want to, I want to stop paying for the coverage and then get that cash value out? Or how would that situation work?
Sure. So there's multiple answers to your question. I know what you're saying. Let's just say you funded your policy for 7 years. And then you, for whatever reason, you just say, I can't fund it anymore, or I'm doing something different. I can switch the policy to what's called paid up, and the cash value that's in there is safe, sound, growing, earning dividends, and the amount of death benefit will be adjusted accordingly, and it would live on. Gotcha. And you could still get into the, borrow against the cash value and do all those features. You could do that. Another option, like you said, 20 years down the road, you say, hey, I'm moving to Panama, whatever. And you just said, write me a check, and they'd send you a check for 100% of that cash value, no surrender charges, no fees. And it's your money to walk with. Now there's no insurance left.
Correct.
You killed the policy.
Right.
You could do that. And there's also, let's just say 20 years down the road, there's another option. You can say, I don't want to put any more of my money in because maybe you just retired and your income went to zip. I want to have the policy pay the annual premium on my behalf. So you're using the growth internally to pay the annual premium, which would then keep everything moving north, growing and the death benefit up as well.
Gotcha.
So a lot of options.
Yeah. No, that's good to know that there's not just one, there's not just one simple answer, to be honest with you, because it gives that person options on what they want to do.
Right.
Well, and the optionality in your toolbox is nice. Similar to, multifamily property. It's, you've got some appreciation coming along the way, which, you can tap into with a refinance or a line of credit somehow. And you're also getting cash flow. Just having some optionality on how you either have access to it or you don't use it. You sell it, for instance.
Right.
Yeah.
Right.
There's another little component that often forget to talk about that's a huge benefit. It's called accelerated death benefit. What that means, if in your later years you come down with a chronic illness or terminal illness, you actually can reach in and grab the death benefit to help you in your needs, your healthcare needs before death, which is really, for how long-term care is really really expensive out there.
Yeah,
right.
So having this asset as well to help mitigate some of those healthcare costs.
So you basically just be drawing down on that life insurance value portion of it. Is that about right?
Yeah, before death, right?
Before death, yeah.
Yeah. So, typically if you have a chronic illness, your life expectancy is around 3 to 5 years. But those are tough 3 to 5 years, right? Because it's all about healthcare.
Yeah.
And so having this instrument to get at the cash is a big benefit.
Yeah. Could be 40, 50 grand a year.
Exactly.
Yeah.
Yeah. Sweet.
Wow. What else you got for us, Mark? Any other tidbits? I mean, I know you've got spreadsheets you can bust out. You've got all sorts of good juicy stuff. What are we missing that you'd like to chat about?
We covered a lot.
Yeah.
I think the one when I run numbers for my clients or potential clients.
Yeah.
It's an education. It's all about knowing how and why it does what it does.
Yeah, you ran it for me. I remember that.
Yep. And do you remember that point right around the third, fourth year?
Yeah.
As you put in $1, you'll see more than $1 show up in cash value for the end of the year. And my fun joke to ask people is when I show them how this instrument's going to behave, as long as you do what you're going to do, here's how the instrument's going to behave. And from this point forward, for the rest of your life, every time you put in $1, you'll see that $1 plus more show up in cash. And I always ask that silly question. If you had an instrument you could do that, how many dollars would you put in?
Yeah, as many as was comfortable.
As many as you could. And that's the epiphany that I try to get everyone to understand is, a lot of us are entrepreneurial, so we go out and start a business. Well, you're in a hole. As soon as you started that business,
Sure
you invested cash, you got money in there, and you don't have cash flow yet. But after maybe 2, 3 years, you've built it up, and now that business is spitting out more cash than you put in, right? The policy is the same thing. It's just more guaranteed to happen.
Right.
Hope that gives you a visual.
Yeah. No, it definitely does.
No, I'd like my dollars to make $1.50.
Right.
Versus my dollar sitting in a bank account making 80 cents. It's actually an 80-cent dollar. Instead of $1, it's 75 cents, whatever it is.
Right.
Inflation's eating away at it.
Literally. Which is obviously value to having reserves, right? Like Mark was saying, 3 months, something like that. Like just to have in there, God forbid, or if you just want to draw from to pay for your life. But after that, it's like, you got to put it somewhere else to make money. Like at the end of the day.
That's right. And I'm down here in the hurricane damage zone.
Yeah.
And a lot of my clients are so thankful they have their policies that's going to help them get through this really, really rough time. So having that cash and that liquidity for emergencies or opportunities is just vital. So.
Right.
Yeah. So we've been talking about opportunities, emergencies are another point, right? Rebuilding the home or, getting through to, having, if your insurance doesn't cover, cause right. I know down there, a lot of insurance companies were flaking out and either pulling out or maybe not even covering. I'm not sure. I'm not down there, but to get you through those emergencies. That's a good point.
Yeah. Yeah. Or, a lot of people are displaced, for employment. So just having that reserves to bridge that gap till they get back on their feet. So it's a Swiss Army knife financial tool, and everyone needs to get educated on it. That's my goal, is just to use a megaphone to tell everybody as I can. Most people run from a life insurance agent, and
I did for a long time.
I was just yeah.
And it's just a tool. At the end of the day, it's just a tool. And again, the death benefit is just a small portion of it. The living benefits are what people are missing out on, and that's why I'm on your show to try to help more people.
So this is whole life insurance. Do I have that right?
That's correct.
Now there's term life. Now, is there universal? Is there like other ones that maybe don't do the same thing? Like why is this whole life the one that can do this?
Yep. Yeah, that's you just stepped in it.
Yeah. Yeah.
So there are a lot of ways to buy life insurance, a lot of ways. And there's the right way, and then there's the wrong way. There's universal life, and there's variable universal life, and then there's index universal life. The difference between those three products compared to the whole life product I'm describing is guarantees. What I have has the guarantees, and those other three do not have guarantees. Gotcha. And they're also built on chassis that are similar to term insurance that have increasing mortality charges. Okay. So the ones that I show, guarantees, are fixed mortality charges. That contract is set. They can't increase your rates. But I promise you, those other three products, as you get older, so are those rates are going to go up and up. And it's reliant on some outside performances, how well these indexes do that they've picked, or a stock portfolio that they've picked. So imagine you've got the increasing headwinds on the cost of your policy, and then you have an event where markets crash. So now you've lost on your cash side, and they charged you more for it. So what happens when people get into their 70s, they'll realize that the premiums are out of their reach now. They can't even afford the premiums. Mm-hmm. So then what happens is they have to reach into the cash of the policy to keep up with the cost of the policy, all depleting the cash. So now you've messed up your retirement and your liquidity in your toughest years, your 70s and 80s. And I have the permission to sell those other products. I have the permission to buy those other products, and I would never endorse that.
Right.
Yeah, I know when we chatted, that was one of my things. Was like, well, what's this? How's this different? How can you provide that? But that makes sense. That's
well, it's what they don't tell you. You're not going to know to ask that question, and it's going to be buried in this very lengthy contract. That's the funny thing. The life insurance contract, the ones I have, is going to be about 15 pages. The number of pages for those other ones is going to be about 50.
Yeah.
which is an extra 35 pages of disclaimers.
Yeah, just compliance.
Oh, no, disclaimers. That we're going to screw this. This is going to blow up on you, and we're telling you now.
Yeah.
In this disclaimer.
So read it and memorize it.
Yeah.
And don't blame us when it happens.
When it happened, yeah.
Yes, that is exactly right. I mean, I've unfortunately had 75-year-old couple come into my office and show me their universal life policy, and they say they want me now to spend, it was $20,000 last year. Now they want me to send in $50,000, and they go, I don't have $50,000.
Yeah.
And I'm like, and he's like, what do I do? And I'm like, there's nothing you can do. It's going to eat up the cash, and then if you die before it eats up the cash, it'll pay the death benefit. But if you outlive the value of the cash, there's going to be no death benefit.
There.
Right.
And the couple just wept in front of me because they always had the vision of leaving that money to their kids.
Mm-hmm. Sure.
And it broke their heart. It absolutely broke their heart. So that's what I meant when you stepped in it. It's not a fun conversation. And unfortunately, there's a lot of agents out there that get in the industry. They get in with one of those carriers, and they train them for that product.
Yeah.
And that's all they know. And they don't even know all those disclaimers that are in there and the damage it's going to do down the road. So I think I read 76% of universal life, IUL, VUL, any of those, only 25% of them actually paid out a death benefit.
Oh my God.
Wow. So if someone has one of those other plans, and I guess you'd probably have to look at that individual plan, but is it transferable? Can you take out and put it into this?
There's what's called a 1035 exchange.
1035.
Just like
a
just like
1031.
I was gonna say,
exactly. So yeah, that's the exit strategy. Is we just get them out of that cash value would port over to the new policy.
Nice, and just set everything up, whether it's like a direct deposit or whatever, however you're funding it, doing it, you can just do it that way.
There might, depending on the policy and the year of the policy, they might charge you a surrender charge fee to do that.
But you'll pay for that for anybody, right? Right, Mark?
Oh boy, I wish I could. Yes, I could. But that's another thing that our policy doesn't have: surrender charges. So again, reasons why I wouldn't do one of those compared to one of these.
Awesome. I think that is a great point right there, because I know as I contemplate and after we've chatted, there's certainly a lot of value there. I saw the spreadsheets. I think that the monthly contribution number I had on there was a little higher than I probably would like, but there was definitely a lot of value with the numbers that you did show me, so I appreciate that. And where my wife has set up our kids on some sort of whole life universal variable, I'm not positive, but I've got to dig deeper into those. It's a good thing to consider as we move forward.
Yeah, I'm happy to review those for you and tell you exactly what they are or are not.
Sure.
But it's likely that's straight whole life.
Yeah,
because the amount of products for kids changes, and for minors compared to adults.
Yeah. And again, my wife brought this up as, hey, we got to do this. And I'm like, for the kids? Come on.
Yeah.
We got to talk about that?
Yeah, I insured my kids. Absolutely.
Yeah, you got to,
And the way I am planning to use those policies, it wasn't for me to make money for me. Mm-hmm. I've been funding them, and it'll be my gift to them when they get out in the workforce, and then they can start putting their own dollars into it, but they'll just had a 15-year head start of the policy already growing. Yep. And that's where, again, I teach this to my clients, and I always want to meet their kids because I want to teach it downstream.
Yeah.
Because it's generational change, for the next generation, the third generation, the fourth generation. If it's being taught at the kitchen table down, it's what all the high net worth individuals are doing.
And that's something we've talked about, is that people don't talk about money. They don't talk about investing. They don't talk about, these types of products at the table. It's always been, taboo,
Right.
I'll talk about it with anybody. Mm-hmm. I'll be like, oh, do you see that, the Fed rates are this and, money and this and that, blah, blah, blah. Watch this, Netflix series, Get Smart with Money. Like, I think that's the greatest thing that has come out. That Netflix series documentary is the greatest. And I let people know about that. Like, talking with your kids about all this stuff makes them better. Whether they say, screw you, dad, screw you, mom.
You don't know what you're talking about.
It's still in their head, right? They're going to have heard it. And then if they hear it out there again somewhere and you kind of make that as a part of your life, generational wealth differences in those families, definitely. I think that's, super important.
Mm-hmm. Absolutely. Well, it's an exciting time. And there's always time to learn something new. So that's what we're talking about.
Exactly.
Yeah.
Exactly.
No, I love this. This was awesome.
Yeah.
To learn all about it.
I really appreciate it, Mark. People can find you on topwealthagenda.com, right? And we put a link to on the Facebook Live here to book a call with you. No obligation call, strategy session, if you will. Book with Mark with a C, markwithac.com. Is that about right?
That's it. Bookwithmark.com. You'll go right to my calendar.
Perfect.
Awesome. Where else? Did I miss anything? Where else can they find you or reach you or see you?
That's the best place to go. Bookwithmark.com.
All right. Bookwithmark.com. Top Wealth Agenda, the bank on yourself principles of whole life insurance. This has been awesome, Mark. I really appreciate it. Thank you so much for bringing some value to everybody that, hopefully is watching and will be listening as we get this out there to the masses.
My pleasure. It's been a lot of fun to talk with you, and look forward to talking some more.
Yeah, definitely. I'll be in touch with you.
Thank you so much.
Awesome. Thanks, Mark.